This is the stock market, the economy, possible outcomes, how to invest. Episode number 184 of the Intellectual Investor Podcast. Thanks for listening. Would you like to get the best articles by Vitaliy from 2022 packed with some art in a beautiful PDF? Head to contrarianedge.com/almanac or follow the link in the show notes. The stock market, the economy, possible outcomes, how to invest. Written by Vitaliy Katsenelson and read by Elliot. This is part one of the winter seasonal letter I wrote to IMA clients, sharing my thoughts about the economy and the market. I tried something I've never done before. Instead of conveying my message through storytelling, I tried to compress my thoughts into short sentences. I summarized some 50,000 words into about 1,000, a compression ratio of 50 to 1. The stock market. Stock market math. Total returns equals earnings per share growth plus PE changes plus dividends. This formula applies to any stock and any stock market. Stock market returns over the last 100 plus years have followed a pattern: long-term bull markets, 15 plus or minus years, followed by sideways markets, 15 plus or minus years, not bear markets. The Great Depression was the only exception. Sideways markets, though, have a flat slope consisting of mini bull, bear, and sideways markets. A lot of volatility, but no real returns. If the stock market PE never changed, stayed at 15 times, there would be no market cycles. The stock market would appreciate with earnings growth, 4 to 6% a year, plus dividends, 4 to 5% a year. Human behavior causes and follows a pendulum-like momentum. Excitement leads to more excitement, CNBC on all day long, or bull market. When momentum breaks, stock market declines lead to more declines, CNBC off, or sideways market. Historically, economic growth was similar during bull and sideways markets. Changes in PE were the cause of bull and sideways markets. Bull markets start when PE is much below average. PE increase plus earnings growth equals high above average returns. At the end of bull markets, PE stops expanding, stagnates, declines. The expectation of endless nirvana is broken. Welcome to sideways markets. Sideways markets start when PE is much above average, end of bull market. PE decline plus earnings growth equals low or no returns. Current valuations. If we normalize for high profit margins, PEs are very high. PEs are likely to decline for a long time. Low interest rates boosted PEs. Higher interest rates take PEs down. Profit margins are likely to decline for several reasons. Selective deglobalization. Widgets made in Ohio are more expensive than ones made in Shanghai. Higher interest rates. Likely higher taxes. If we are lucky, we will have a sideways market. If unlucky, the economy goes into long-term stagnation. We'll have a secular bear market. The most recent secular bear market was in Japan. Both PEs and earnings declined for a long time. We are not Japan, but nor was Japan in the early 90s. The economy. The economy is still difficult to analyze. It has been impacted by COVID distortions, too much, too little demand, supply chain disruptions, $5 trillion of debt issued by the U.S. government. Tailwinds. Historically, a bet against the U.S. consumer and U.S. economy was a losing one. The consumer has a lot of pandemic cash. Unemployment is low. The financial/banking system is in great shape from the perspective of reserves and credit quality. Selective deglobalization will bring some jobs to the U.S. Major headwind. Rising interest rates. The economy is addicted to low interest rates. It will take time and pain to readjust from zero rates to average or above average rates. Trillions of dollars of long-term, low-coupon debt have been issued, which will bring pain to holders who will be taking realized or unrealized losses. First, second, and third-order effects will be surfacing in the financial system. The Silicon Valley Bank bankruptcy leaps to mind here. Corporate debt is at an all-time high. Debt paydown will take place at the expense of share buybacks, fewer capital investments, less growth. Housing market good news. Most mortgages are fixed rate, not impacted by higher rates. If homeowners don't move, they don't feel the impact of high rates. End of good news. Home prices in relation to income are at an all-time high. Unless income skyrockets, homes are unaffordable to new buyers. Declining home prices will erode home equity and consumer confidence. The number of transactions in the housing market will reset to a semi-permanent lower level. At the new higher rates, if you sell your house and buy one next door, your mortgage payment doubles. This also impairs workforce mobility. It's unclear if unemployment will stay low. Tech companies have just started laying off high-earning workers. A lot more pain is likely. This is the worst geopolitical environment in generations. War in Europe and China soon to be the largest economy, but not a friend. Defense spending increases are almost a certainty. U.S. debt to GDP is 130%, the highest level since World War II. Higher interest rates will lead to more money printing to pay for higher interest payments and increases in defense spending. Companies are choosing the resilience of supply chains over efficiency. Selective deglobalization leads to higher costs and adds to inflation. Inflation leads to the reduction of purchasing power, lower savings, decline in production, which causes stagflation. Higher corporate and income taxes are likely. It's almost irrelevant who runs the country. High taxes are destimulative and lower growth. Higher unemployment is likely. Possible outcomes. Inflation gradually subsides. The economy slows down a little, but is still growing. Interest rates normalize at a semi-normal level. That is a Nirvana 1.0 outcome, a garden variety sideways market. Or, even better, corporate margins don't deflate but stay at current all-time high levels. This is the Nirvana 2.0 outcome. Market appreciation more or less matches the growth of the economy. Inflation persists. Inflationary sideways market. Nominal earnings growth plus declining PEs. Eventually, inflation breaks by itself through stagflation or with the help of the Fed. Next, inflation is broken. Economy in short-term recession. Short-term bear market, long-term sideways market. Inflation leads to deflation or long-term recession. Bear market rhyming with the one in Japan, or if interest rates go negative, shoot the moon bull market. Or an outcome I did not think of. To summarize the preceding, long-term stock market returns have two sources: earnings growth, which is under pressure for a longer list of reasons than usual, plus valuations, which are at historical highs and also under pressure. How to invest. Worry macro. That is what I did earlier. Invest micro. This is what I'll discuss next. Look for companies that can survive and prosper in all of the preceding scenarios. Be process-driven. The market will likely be more bipolar than usual. Know what you own, why you own it, and how much it is worth. You need to have patience. Wait for opportunities to come to you. Competitive intensity will likely increase when the economic pie is not growing. Stick to high-quality companies run by great people. Increase your margin of safety. You'll need it. Don't be afraid of cash or short-term bonds when you don't find opportunities. Cash is better than overvalued stocks or low-quality companies, or especially the combination of the two. Look for stocks in other markets. They expand choice greatly. Don't time markets. It's impossible to put market timing into a process. Buy undervalued companies and sell them when they are dear. Sell is a four-letter word in secular bull markets. It is an important practice during sideways markets. Until my father read my book, Active Value Investing, he thought investing was a legalized form of gambling and that I should do something real, such as open a bagel store or donut shop. He even offered to help. After writing this, I realized that over the next decade or two, there will be times when I wish I had taken my father up on his offer. Investing will be challenging as the stock market and economy enter a phase of repaying for the excess of the past. I am fortunate to have a passion for investing, not bagels. P.S. I asked IMA clients for feedback on this style of writing. Some appreciated the conciseness of the format. One client, a software engineer, suggested that I reduce the compression rate from 50 to 1 to 10 to 1. However, most felt that storytelling is what attracted them originally to my writing. I have to confess, though I enjoyed the challenge of compressing thoughts into compact sentences, the highlight of the essay for me was writing about the bagel shop. Introduction to Rondo. Today, I would like to share with you a wonderful short, light piece, Introduction to Rondo, by French composer Camille Saint-Saëns, 1835 to 1921. Saint-Saëns originally intended this piece to be the conclusion for his violin concerto, but then changed his mind and left it as a standalone composition for violin and orchestra. This is one of the most popular and frequently performed pieces for violin, and I will share with you a number of performances by some of the biggest names in the violin world. However, before you listen to the violin performances, I would recommend that you first listen to Georges Bizet's 1838 to 1875 arrangement for two pianos. While it provides a great silhouette of this piece, it lacks the emotional punch that the violin brings to it, thus pointing up the great contrast between the emotional impact of the violin versus that of the piano. For fun, why not? I'll add some cello, flute, and guitar arrangements. You can find links to those in the show notes. Thanks for listening. If you know someone who'd enjoy this episode, share it with them. To listen to more episodes, visit investor.fm. Enjoy life and prosper.